Welcome back, dear students and scholars. In the previous video, we focused on classification and held to maturity securities. Now we move to the category that reaches the income statement the fastest, trading debt securities. Under US GAAP, trading securities are measured at fair value at each reporting date, and every fair value change goes directly into net income. There is no stopover in other comprehensive income and no waiting for sale before recognizing the market movement. In this lesson, we will identify the trading purpose, measure the security at fair value, record unrealized gains or losses in income, and then handle the sale without double counting. Trading is the most earning sensitive category, so small fair value movements can quickly make the income statement look very active. In simple words, trading securities do not whisper in the background, they speak directly through earnings. The trading classification begins with purpose. A debt security is trading when management buys and holds it principally for sale in the near term. That means the strategy is not to collect contractual cash flows until maturity, and it is not merely to keep the security available for future liquidity. The strategy is active profit taking from short term price movements. That is why trading is fundamentally different from held to maturity. HTM says we are committed to the end. Trading says we are watching the market and may sell soon. Available for sale sits somewhere between those two. So when you see a fact pattern, first ask whether management acquired the security for near term sale. If yes, the accounting answer moves quickly toward fair value through earnings. Trading securities are reported at fair value on the statement of financial position at every reporting date. Original cost is important because it establishes the first carrying amount, but it does not remain frozen. At period end, the carrying amount is adjusted to current fair value. The difference between the old carrying amount and the new fair value becomes the current period gain or loss in earnings. Trading securities are also generally presented as current assets because the holding purpose is near term sale. The process repeats each reporting period. Measure, compare, record the difference. That rhythm is important. In trading accounting, fair value is not just disclosure information, it is the measurement basis and the income statement trigger. For trading securities, everything relevant goes through the income statement. Interest income goes to earnings. Premium or discount amortization goes to earnings. Realized gains or losses on sale go to earnings. Unrealized holding gains or losses also go to earnings. There is no temporary parking lot in other comprehensive income and no accumulated other comprehensive income balance building up in equity. That is the defining feature that separates trading from available for sale. If AFS is the category that says, let us park this fair value movement in OCI for now, trading says no parking available, please proceed directly to net income. That is a light way to remember it, but the technical point is serious. Trading bypasses OCI entirely. Now let us set up the 2026 mini case. On January 1st, 2026, the entity buys a trading debt security for $100,000. That amount becomes the initial carrying amount. By December 31st, 2026, the fair value is $104,000, which means fair value increased by $4,000. During the year, the entity also received $6,000 of cash interest, and that interest is recognized in earnings. The security was classified as trading at acquisition, so we do not need to test HTM commitment or AFS treatment here. The exam style question is, what total amount reaches the 2026 income statement? Keep the two pieces separate first. Interest income is $6,000 and the unrealized fair value gain is $4,000. When fair value rises above carrying amount, the direct write up method increases the trading security asset account. In this example, year end fair value is $104,000 and the January 1st carrying amount was $100,000. The fair value increase is $4,000. The journal entry is debit trading debt securities $4,000 and credit unrealized gain on trading securities $4,000. That credit increases current period earnings. Combined with the $6,000 of interest income already received during 2026, the total earnings impact for the year is $10,000. The balance sheet now reports the trading security at $104,000. Notice how the number reconciles cleanly. 100,000 plus 4,000 equals 104,000. Now look at the alternate loss scenario. If year-end fair value falls to $96,500, the decline from the $100,000 carrying amount is $3,500. Under the direct write-down method, the entry is debit unrealized loss on trading securities, $3,500, and credit trading debt securities, $3,500. The loss reduces current period earnings immediately. There is no threshold test, no waiting period, and no OCI deferral. The security account moves down to $96,500, which equals fair value. This is why trading securities can make earnings more volatile. The market moved, so the income statement moved with it. Trading accounting is not shy. Instead of directly adjusting the trading security account, an entity may use a valuation allowance contra asset account. The income statement effect is the same, only the balance sheet presentation route changes. In the loss scenario, the entry becomes debit unrealized loss on trading securities $3,500 and credit valuation allowance trading securities $3,500. The security may still show historical cost of $100,000, but the valuation allowance of $3,500 is deducted to arrive at fair value of $96,500. So the reconciliation is clear. 100,000 minus 3,500 equals 96,500. Same fair value, same earnings effect, different presentation route. The accounting destination is the same, even if the road has a slightly different signboard. Now we handle sale after fair value has already been recorded. This is where double counting can easily happen. Suppose the security was already written up to $104,000 at year end, and then it is sold for $105,500. The new gain at sale is not $5,500 from original cost. The $4,000 unrealized gain was already recognized earlier. So at sale, the entity recognizes only the incremental gain above the last carrying amount, 105,500 minus 104,000 equals $1,500. The sale entry is debit cash $105,500, credit trading debt securities $104,000, and credit realized gain on sale $1,500. The rule is simple. Once a gain has gone through earnings, do not invite it back for a second performance. This comparison table brings the whole classification logic together. Held to maturity securities use amortized cost, and unrealized fair value changes are not recognized. Trading securities use fair value, and unrealized changes go to net income. Available for sale securities also use fair value, but unrealized changes usually go to other comprehensive income until realization. That means the same bond can create very different financial statement results depending on classification. For today's video, the most important memory line is this: trading is the earnings bucket. HTM avoids recognition of unrealized fair value changes. AFS parks changes in OCI. If you keep those three landing zones clear, most ASC 320 classification questions become much easier. Let us close with the trading securities checklist. First, the trading purpose must be supported. The security was acquired principally for near term sale and active profit taking. Second, the security is measured at fair value at each reporting date. Third, interest income goes to earnings. Fourth, unrealized gains or losses go to earnings with no OCI deferral. Fifth, realized gains or losses on sale go to earnings, but only for the incremental difference from the last carrying amount. Sixth, trading fair value changes do not park in OCI. Up next, we will move to available for sale securities where fair value measurement still applies, but unrealized changes generally move through OCI and AOCI instead of current earnings. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with your colleagues who are learning US GAAP. I will see you in the next video.